Hello there, welcome to another video on investing in the stock market on this sunny day. Now today I want to gather my personal thoughts, just my thoughts, on how to avoid losing stocks. Not necessarily picking the winners but avoiding the losers. Because you see all of these crap companies performing terribly and the stocks are standing still or going down while the rest of the market is on a bull run, and you think to yourself, how, when and why did anyone think this was a good idea? You know, why did anyone invest in General Electric 3 years ago instead of Amazon? And these examples. And so these are just some of the ways I think you could avoid investing in those obviously bad plays. So the biggest obvious one, and in my opinion the most important thing about a company, how fast is it growing? Because when we're talking about stocks, you want to look into the future, and future is all about growth, and that's what's gonna make investors give a company money, and it's what's gonna make the stock appreciate over time. So does the company show healthy growth rate? It doesn't have to grow at 40% like Amazon or Nvidia, these crazy high-flying tech stocks. It depends on industry, size, and what they sell. But the average growth rates of the S&P 500 is just about 12%. So I would say, unless there's a good reason why the company you're looking at is showing low growth, like single digit, it should at least climb above 10%, preferably more than this. But again, you need to look at every company in an industry specific way. So always compare companies to other companies in the same industry. So go for the industry leader and compare the growth rates. Now, is the company showing strong innovation? So this is all about creating new revenue sources and incrementally increasing existing ones. So for example, innovation from Apple could be improvements of the iPhone or the release of a new product like the Apple Watch. So if a company is simply relying on old models and old products and services, they will probably not experience a lot of growth, and they will be prone to attack from younger companies relying on innovation. So no matter how big a company or well established it is, I want to see innovation. And from the big, slow giants that we now have, you know, companies that were started during the 1900s, which are now $100 billion companies, I want to see change and improvements of their current products and services catered to today's need and what people will want in the future. So it could be a traditional company selling products dominantly bought by older people to try and find out what young people want to buy and try and change their portfolio or the way they do business based on that. Now, one macro economic aspect which is just as important as these two other ones, and one that a company can't really control, is the demand increasing or decreasing for their products or services? So some companies in the cable TV industry are struggling because the demand is decreasing and will continue to do so indefinitely. So a company can either, you know, do very well in a decreasing space, or they can try and diversify away from it. You want probably the latter to be the case. So an example could be sugary foods and beverages versus organic healthy foods. Young people today, they're not so much about the sodas and candy stuff. They're more about organic and healthy foods. You know, whole foods would be an example of that. Now, number 4, which is in the same line as the third one, is the company fighting an inevitable trend. So I use the example streaming robotics. You could also probably put e-commerce in there. So we see inevitable trends in society amongst young people especially, but the public in general, or manufacturing in general. And if the company is in such a position where all the new big companies are coming in with this new trend and they are forced to fight it and play defense, the question is, do you really want to be invested in that sort of company when it's really fighting a losing battle? So it doesn't matter how well you're fighting, it doesn't matter how well the last 300 samurais fought when they were outnumbered 50-1. It just simply doesn't matter. If you have a sword and you're fighting guns, doesn't matter how good your skills are. So this is a big one, and I'm not invested in any company where this or this is the case. So to the fifth point, and continuing the same line, but this doesn't have to be because the company's in a struggling sector or fighting off a trend. Is the CEO playing, or do you feel that the CEO is playing offense or defense? Is it expanding or maintaining? Is it all about innovation or increasing margins and making stuff more efficient? They can both work, but I personally want a CEO to be all offense, to just look at the company he or she is running and the future. How can we reach the future as fast as possible? And that's the most important thing, because if you have the brand new best product or a new service that the rest don't have, you're going to win almost regardless, right? You can be operating at a loss as long as you're showing enough expansion and innovation and aggression, right? I keep bringing up Jeff Bezos, but he's the best business leader in the world. He might turn out to be the most successful CEO of the last 100 years or so, and it's all offense. It's all offense. He crushes everyone in his path, not as a day-to-day operator or balance sheet specialist. He's just looking, what can we do better? What does the consumer want? I'm not too worried about all these big competitors as long as we are at the front of innovation and service and e-commerce. No one can mess with us, and it has worked so far. So the example would be, and again, I'm not bashing Macmillan, but Bezos versus Walmart CEO Macmillan, they're forced into two different roles. Macmillan is forcing suppliers and using their leverage to defend off Amazon and make sure they stabilize and maintain at least a positive growth rate. Amazon is just, what can we crush next? And again, Walmart might outperform Amazon. Who knows? Probably not, though. And the question is, which stock would you rather own? To almost finish off, just a couple of examples. Now, this might be just because I'm a millennial and I don't know what the hell I'm talking about. But here are just some examples which shows what I've been talking about. So when it comes to tech, would you rather be in IBM or Nvidia? Would you rather be in Walmart stores or Amazon? Would you rather be in AT&T and Netflix? So again, I'm not bashing these three companies, but I'm just saying they're facing really tough, younger, more innovative, more nimble competition, and they're forced into a defensive stance. And the stocks have shown that. If we compare the stocks, it's not even going to be funny. It's going to be an absolute bloodshed. They've been tripled, quadrupled. I mean, they've probably returned 10 times as much at least, these three newest companies. It's not always going to be the case, and these three companies will slow down over time. But look at the stocks, look at the companies, and notice that this has been the case for quite a long time. I would probably have said the exact same thing in 2013 or in 2010, yet some people still invested in IBM. They still invested in Walmart stores and not in Amazon. So take it how you want. And then just a line of wisdom I came up with on my own at the end here, which is sort of explains the way I invest, and my beef with value investing is that it doesn't matter how valuable a ship is. A valuable ship is worth nothing if it's sinking. So are the arrows pointing up or down? For all my companies, the ones I own in my personal portfolio, they're pointing up. And it doesn't matter how great the company, if it's going the wrong way, I'm not investing. I'm sorry. So hope you learned something. Drop a comment if you have any questions. Keep investing. I'll see you in my next video.